For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Yeah, welcome back to the program. I'm all excited today. Professor Rick Plum, CFP professional. Hello.
Good morning.
Are
Good
you
afternoon. Good evening.
Are you all excited for today? I don't know why. I feel like I got a lot of energy today, and I don't know what. Well, no, I do know what
caffeinated.
It is. I ran across something. I'm your podcast host, Johnny Dean, by the way. You folks know this. You know who we are. You've been listening all these years. You know exactly who we are. And one thing that I get excited about, Professor Plum, is when I read something from a respected person in the world of finance, especially. And it speaks to everything that we've ever talked about on this show, and it agrees with it, and it kind of demonstrates why we've been doing everything we've been doing, why the bucket strategy
works.
Yes, can I say that?
I did.
How it works over the last, and why we've espoused this particular strategy over now more than 30 years, right? 30 some odd years. Yeah. So I always get all excited about that when I say, there's a light bulb that went off.
So who is this individual that you've been reading up on?
Well, we've talked about this person once or twice before, and I think he's brilliant. His name is Morgan Housel, and he wrote a book called The Psychology of Money. And I really...
That's a good one. The psychology of money is very important.
It is important.
Because it will make our decisions... the emotional decisions sometimes outweigh the financial considerations when we're looking at how to make a decision.
There are incredibly intelligent people out there who can make really bad decisions emotionally and completely mess up their lives. But there are also people who know nothing about finance, but just make the right emotional decisions and can be extremely successful financially. And that's what a good plan, I think, will do.
Right. And some of it is, are you reacting to something, or are you looking forward to something?
Yes, right. Yes.
Because when we react, in many cases, we react wrong.
Well, and this is what the bucket strategy aims to
avoid.
Let's put it that way. Have you heard of this person? Let me preface this by saying, because this is what got me. I read about this guy. Have you heard of a person named Rick Garen? Guerin, if I'm pronouncing
familiar,
it right.
But
okay.
I couldn't pull him up right now.
You have heard of Warren Buffett and Charlie Munger, right?
I've heard of them. Never met them, but I've heard of them.
Well, you won't meet Charlie.
Well,
we could meet Warren at some point, but anyway, we better hurry. Obviously, very successful people.
Very well known.
Berkshire Hathaway, right? Yeah. Yes, and if you don't know who they are, look them up. Warren's been investing since age 10, and he's like in his
and he's never spent a dime that he made, basically.
90s. Well, supposedly. All right, but there was so you have Warren Buffett and Charlie Munger, but 40 some odd years ago, there was a third member of this group, and it was this person named Rick Garen. Okay. So Warren, Charlie, and Rick made investments together. Okay, they were kind of a team, and they interviewed business managers together, and then somehow Rick disappeared. At least relative to Buffett and Munger's, success. We've heard of the two of them. So what happened to this guy? Well, Warren was being interviewed, Warren Buffett, and he said, Charlie Munger and I always knew that we would become incredibly wealthy. We were not in a hurry, though, to get wealthy. We knew it would happen. Now, Rick Garen was just as smart as we were, but he was in a hurry. Now, here's what happened. Just 10 seconds. What happened was that in the 1973-74 downturn, Rick Garen was levered with margin loans.
He was pushing the envelope in 71, 72.
Trying to...
And using margin, borrowing money to buy more securities.
Correct.
To take more, to leverage up his returns.
Right. And the stock market...
72, 73. For those people who were not around at that time, or investors at that time, that was a bad time to be an investor in the stock market.
Well, the stock market, according to this, went down almost 70% in those 2 years. So he got what are called margin calls. Right. In other words, pay up.
Yeah.
Right? So he sold his Berkshire stock to Warren Buffett. Warren actually said, I bought Rick's Berkshire stock at under $40 a piece. Okay? Now
$40 a piece in 1973.
73, 74, somewhere in there. Right. Rick was forced to sell because he was all levered up. Now, here's the point, and this is what Morgan Housel said. Charlie, Warren, and Rick were equally skilled at getting wealthy, but Warren and Charlie had the added skill of staying wealthy, which over time is the skill that matters most. Getting wealthy versus staying wealthy. We've preached this for a long time, that getting wealthy requires a certain set of skills, and staying wealthy requires another.
Yes. I mean, because getting wealthy, it depends on how you're trying to do it. If you want to do it quick, you can do it by taking an extreme amount of risk. Will either make you very wealthy or very poor.
Yes.
Sounds like the gentleman here involved. Whereas once you have money, trying to keep from losing it, but turning that money into something useful, meaning some kind of a cash flow, takes a completely different skill set.
You cannot do the same thing. By the way, it was $40 a share back then. Did you look up what the stock is? What is this stock now?
Well, basically, he lost out on a 51-year annualized 20% return.
Okay, and so the stock is somewhere around
$605,000
a
share,
sold for 40. So,
but that was 51 years ago.
It was 51, but there it is. You see, time is the element. Okay,
and there've been times where the particular fund that we're talking about, people thought that the remaining two, Charlie and Warren, were idiots. They were old school. They lost their edge. They couldn't do anything right. I'm talking about the tech boom.
Yeah.
People thought, because the particular fund didn't go heavy into tech like a lot of people did. They like to buy what they knew, more value oriented. So, and people were saying these two guys have lost their edge. They don't know what they're doing. They're too old. They've not changed with the times.
Right.
And then, a couple years later, they were proved to be smarter than smart again. They were geniuses again.
Because they were not in a hurry. The whole thing of the .com, get wealthy today. Look at this. I mean, history is rife with this. So here's what Morgan says. Now, he says, if I had to summarize money success in a single word, it would be survival. I'm going to get your comment on this. Capitalism is hard, but part of the reason this happens, he says, is because getting money and keeping money are two different skills. Getting money requires taking risks, being optimistic, and putting yourself out there. But keeping money requires the opposite of taking risk. It requires humility and fear that what you've made can be taken away from you just as fast.
Well, how many people... I'm sorry, go ahead.
Hold on. It requires frugality and an acceptance that at least some of what you've made is attributable to luck, so past success cannot be relied on to repeat indefinitely.
Well, I was thinking, when you were talking about that, I was thinking, how many people go to Vegas and actually win and walk away with their winnings?
Well, that's true. Now, okay, so this comes down to three things, according to Morgan Housel in this book, Psychology of Money. And I'll read a little bit of this, and I want your comment on this, because this all connects to what we've been saying for all these years, decades now, okay? And I get excited when this happens. So he says, applying this survival mindset to the real world comes down to appreciating three things. First one is, he says, more than I want big returns, I want to be financially unbreakable. More than I want big returns. He says, if I'm unbreakable, I actually think I'll get the biggest returns because I'll be able to stick around long enough for compounding to work wonders. Now,
that sounds very familiar.
Doesn't it? He says, no one wants to hold cash during a bull market. They want to own assets that go up a lot. You look and feel conservative holding cash during a bull market because you become acutely aware of how much return you're giving up by not owning the good stuff. Now, this is written a few years ago. He says, say cash earns 1%. Okay.
Which it did for a long time.
Well, it did. Say cash earns 1% and stocks return 10% in a year. That 9% gap will gnaw at you every single day. But if that cash prevents you from having to sell your stocks during a bear market, the actual return you earned on that cash is not 1% per year. It could be many multiples of that, he says, because preventing one desperate, ill-timed stock sale can do more for your lifetime returns than picking dozens of big-time winners.
Boy, that sounds like buckets.
This is, you see why I got excited? He's last sentence. Compounding doesn't rely on earning big returns. Merely good returns sustained uninterrupted over the longest period of time, especially in times of chaos and havoc, will always win.
This sounds so much like buckets.
Why do we do buckets? Because of this.
We never want to be put in a position where we are selling something in a down position where we have to sell more shares than then we'd had to, if I need $10,000 and I have a stock that's worth $10, I'm selling 1,000 shares. But if a year later, if I need that same 10,000, but the stock market has dropped by 20%, I got to sell 1,250 shares, to get that same $10,000. I never want to be put in that position.
Right.
And the problem is, there are going to be more years that are up than down, but nobody has been able to predict with any consistency the downturn years, A, when it's going to happen, B, how far it's going to go down, and C, how long it's going to take to reach the bottom, and D, how long it will take after the bottom to reach back to where I was before this all started.
That's it. Match your assets to your liabilities.
Yep.
You have a short-term liability, have a short-term assets where the cash part came in.
The liability is I need to spend some money.
Yes.
So this is why there's a big difference between that 25-year-old starting out with their 401k or their investing. They can take the risk because if they lose the $50 they put in, they lose $50. And if the market goes up 200%, they feel pretty good about it. They're still not ready to retire yet. On the other hand, if we as a retiree or close to retiree lose 50% of our investment nest egg, not only does it make it more difficult to retire, but it does something to us in our psyche. It scares the living heck out of us.
Right.
And we're more likely to make our knee-jerk reaction and sell not only what I might need to spend, but everything so that I don't lose more.
But if you don't need if you have the cash that you need and you don't have to worry about, regardless of what the market is doing, you're most likely not going to fall
and this is where
victim to that.
This comes into buckets in general, but it also leads credence to the lifetime income, having enough income, pensionized income, Social Security pensions, lifetime income to cover your fixed expenses of retirement so that when the markets go down, that you're saying, well, I've got my income covered. Why do I,
You're buying time.
It's no fun to watch the market go down, but I don't have an immediate need to sell anything to satisfy any upcoming expenses. I'm covered. And so I can emotionally ride out this wave. And the wave, it goes both ways. And that's where it was either last week or the week before we talked about volatility is not risk.
Right.
Risk is how you react to that volatility.
Risk is needing the money and you don't have it.
Risk is setting yourself up inappropriately. This is what Orange County, many people,
California
in 1993, 94, when we had what was the most touted government financial gurus managing a county's money, they went from being, sought after to do speeches to bankrupting one of the wealthiest counties
because they took a risk.
Because they went out long
and
for short-term money.
Boy, did we? That was another time where we touted this.
And we started doing buckets right about the same time that they were going through this, and it really drove the point home. Do not cover a short-term liability, the need to spend money at a specific time in the near future, with a long-term asset.
Well, and this goes into the second thing. I mentioned there are three that Morgan Housel mentioned. Okay, three things, appreciating three things. Here's the second one. He says planning is important, but the most important part of every plan is to plan on the plan not going according to plan.
We talked about this either last week or the week before. I can't remember which sequence when our engineer friend was on.
Yes.
Stress testing your plan.
That's right.
Try to break it. What is going to break this strategy? What is going to break my plan?
Yes.
What are the worst case scenarios that we can think of? Now, there could be worse ones that we can't think of, but let's bombard this thing and see how it reacts, how it works, to make sure that if things happen, I know I'm okay in everything that I can consider. There's always black swan events.
He says, I'll read this just a minute or two here, a minute maybe. He says, a plan is only useful if it can survive reality, and a future filled with unknowns is everyone's reality. A good plan does not pretend that this is not true. It embraces this fact and emphasizes room for error. The more you need specific elements of your financial plan to be true, the more fragile your financial life becomes. If there's enough room for error in your savings rate that you can say, hey, it'd be great if the market gets, returns 8% over the year for the next 15 years. But if it only does 4% a year, I'll still be okay. The more you can say that, the more valuable your plan becomes. Many bets, he says, fail, not because they were wrong, but because they were mostly right in a situation that required things to go right. Exactly right. room for error, margin of safety, is one of the most underappreciated forms of finance. It comes in many forms. A frugal budget, flexible thinking, and a loose timeline. Anything that lets you live happily within a whole range of potential outcomes. And it's not being conservative. Conservative is avoiding a certain level of risk. Margin of safety is raising the odds of success at a given level of risk by increasing your chances of survival. Now, to me...
Well, that's awesome.
You see? I'm like, I got to talk about this.
That is why we do the planning that we do for people that are looking to change from an accumulation mode, which actually is much easier to do, than to a distribution mode. We're moving towards, when we're 25, 35, 45, creating wealth. The hardest part is actually taking money out of our pocket and getting it invested. Whether you're using the XYZ growth fund or the ABC growth fund is probably, that's less of an issue than whether you can put $50 or $100 a month away or some number. You're going to build wealth by the discipline of saving. But once you have that wealth, now comes a different plan, because you don't have time on your side. Right. You have to get it right going forward. When you're saving money over 20, 30 years, whether you're starting at 71 and the market drops 50%, or you're starting in 73 at the bottom of the market, 20, 30, 40 years later, it's not going to matter much. I mean, it's going to make a minor, you'll never notice the difference.
No, you won't.
But on the other hand, if you're starting to create a distribution strategy and you're starting in 2000 versus starting in 2009, those, the top of the market on one, the bottom of the market on the other, that is a big difference in survivability.
You just segued right into the third point.
And what is the third point?
This is why I knew you'd be good with this, Professor Plum, because you live this
every day.
Okay, so the third thing that Morgan Housel says he appreciates, and again, this is out of Psychology of Money, a book. The third thing is appreciate a barbelled personality, and we've mentioned this before.
Oh, we've talked about the barbell approach.
Optimistic about the future, but paranoid about what will prevent you from getting to the future is vital. Now, optimism is usually, he says, is usually defined as a belief that things will go well, but that's incomplete. Sensible optimism is a belief that the odds are in your favor, and over time, things will balance out to a good outcome, even if what happens in between is filled with misery. And in fact, it will be filled with misery. You could be optimistic that the long-term growth trajectory is up and to the right, like a graph, right? Yeah. But you can be equally sure that the road between now and then is filled with landmines and always will be. This
sounds familiar.
Doesn't it? These two things are not mutually exclusive. He says the idea that something can gain over the long run while being a basket case in the short run is not intuitive, but it's how things work in life.
It may not be intuitive, but it's reality.
It is reality. It's not intuitive. Now, I found this chart, which it's real GDP per capita. Of course, you can't see this on the podcast.
Charts and podcasts work real well.
I'll show you. From 1850 to 2020. That's 170 years. Okay?
I haven't been there for all of those years. A few of them, but not all.
More than you'd care to. Okay, so in 1850, real GDP per capita was about $4,000, somewhere in there. Okay, in 1850, 170 some odd years ago. Now, up through 2020, real GDP went from 4,000 or so in 1850 up to about 80,000 in 2020.
Okay.
That's about a 20-fold increase.
And looking at the line, it's not a straight line, but the trajectory is fairly stable all the way through. There's a little bit of a problem in the 20s, I'm guessing.
There's a dip in 1930, 29, yes. Yeah. But
mostly the line is...
But did you notice it evens out? People can't see this, but it evens out.
Right. If you started in a straight line from 1850 to 2024, and you made a straight line, the graph line is almost on that line all the way through.
You could almost put a ruler and watch it go up.
It's not much different than how I would draw a straight line, because I'm horrible at drawing.
If you were driving in a truck, and that's... Okay,
over a bumpy road.
So now it went up 20-fold. Our standard of living went up 20-fold over the 170 years between 1850 and 2020. But do you know what happened during this period? Where do we begin, he says. Get this, during this 170-year period. 1.3 million Americans died while fighting 9 major wars. Roughly 99.9% of all companies that were created during that time went out of business. 4 U.S. presidents were assassinated. 33 recessions lasted a cumulative 48 years. The number of forecasters who predicted those recessions rounds to zero.
I've never met anybody.
They can't predict it. The stock market fell more than 10% from a recent high at least 102 times during that period. Stocks lost a third of their value at least 12 times. Annual inflation exceeded 7% in 20 separate years, and the words economic pessimism appeared in newspapers at least 29,000 times during that period of time, according to Google. Now, here's the last thing on this. Our standard of living, as I said, increased, though, with all that, increased 20-fold during those 170 years, but barely a day went by that lacked tangible reasons for pessimism.
Well, there's always something that'll affect the market. Didn't mean to interrupt.
No. The last thing, and then you can comment. He says a mindset that can be paranoid and optimistic at the same time is hard to maintain because seeing things as black or white takes less effort than accepting nuance. But you need short-term paranoia to keep you alive long enough to exploit long-term optimism. Boom, buckets, Professor Plum.
We use short-term assets to get through the short-term uncertainty. We use long-term assets to take advantage of what the market has shown in history to always give us. It fits everything we're trying to accomplish. This guy, without saying buckets,
he didn't say it at all.
Maybe he's never even heard of buckets. I don't know.
No, actually, he has, and he has mentioned it in others. But the fact that what he's saying, which is so true, and these are facts. These are 100% facts. That if you lack short-term staying power, you're not going to be able to last over the long term.
I just know that I've listened to people for the last 30, 40 years talk about the market, the economy, things of that nature. And there's always something that we couldn't imagine that can affect the market. I go back to the tsunami in the Fukushima nuclear plant. What was that, 2011 or something?
Go back to September 11th.
Go back to September 11th. You go back. There's always, and then there's things that we know are going to happen. We knew that in the 2005, 6, 7 time horizon that real estate was getting out of control.
But did we?
We knew it was going to fall, but we didn't know when, and so we didn't want to be left. We always thought we could get in and get out just before. We wouldn't be left holding the hot potato.
No.
Go back to the tech boom. We knew that was unsustainable. Everybody knew that this was ridiculous.
Did we?
But come on. I mean,
hey, everybody said, Warren, you're out.
Well, they said, and
this is it for going forward. This
Greenspan
is the new,
in '96 said this is crazy, and he was wrong for 4 years, but then he was right. We knew that there were problems, but we didn't want to miss out, and so we played the game. And if you could, but nobody could figure. I think I was listening to Peter Lynch, a famous money manager, and he was just talking about interest rates, and he said, if I could predict the direction of interest rate changes correctly 3 times in a row, I'd be a billionaire.
Well, and you're right.
I may not. Maybe it wasn't him, but I'm giving him credit for it.
But what you're right. You're right. And the problems that we've seen are people who are thinking short term. It's Rick Garen all over again.
It's Orange County all over again.
Exactly. It's people who are saying I can step outside and I can beat the short term. I'm going to get here quickly. It doesn't work
draw to that inside straight.
Right. You have to have a long-term approach when it comes to finance, Professor Plum. And buckets, when we talk about it, most people listening understand buckets. Can you give the 1 minute? Tell people how this works in 1 minute.
Short-term assets to provide short-term needs, long-term assets to provide long-term needs. That is the bottom line crux of what we're doing with buckets. We don't use stock market or volatile assets to create the cash flow that we need in the next 3, 4, 5, 6, 7 years. We use, and luckily now at least we're getting paid a little bit for having some safer.
It's not 1% anymore.
It's in the 4 to 5% range. So we use short-term assets for short-term liabilities, mid-term assets for mid-term liabilities, long-term assets for long-term liabilities. Then we take it from there and we then add in more things to combat the emotional issues, lifetime income and things of that nature, if you need it. Some people do, some people don't. And, create appropriate portfolios to match the time horizons for the expected need. Now, that doesn't necessarily mean that we are predicting that the market's going to crash tomorrow, next week, next year. We don't know. but we're creating short-term money in case it does. But we also have long-term money. And what if the market goes up 20, 30% over the next 12 months and you thought it was going to go up 10? Silly you. Now you have more return. The question then becomes, do we play with the house's money and go all in, stay all in? Or do we pare back some money, refill bucket number one, stretch our time horizon again? Those are discussion points, not automatics.
Now, you're correct. You said that we don't know when the market's going to crash. We know that it will. But let me tell you something. We do know that there will be landmines. I mean, every week. I don't care how good the economic news is, there's going to be something. The Morgan Housel mentions landmines because they're there all the time.
And we talk about landmines all the time.
And we don't know what it will be, but I can almost guarantee you that over the course of the next 2 months, 3 months, 2 weeks, 3 weeks, whenever you happen to be listening to this,
between now and November,
there will be, just any time, any period of time, there will be horrible landmines. You know, this company is, inflation did this. I mean, short-term news. So you've got to have a strategy that gets you through those,
right,
so that the landmines don't blow up in your face and ruin you.
And the goal is to avoid those landmines.
Yeah.
But then be in a position to take advantage.
To pick up the pieces of the
either
debris.
The landmine or the missed landmine.
Well, whatever it is, they're going to go off. I hate to keep using this sort of war term, but that's what it was. That's kind of how it is.
It's definitely, there are so many things that can derail, so many things that can, screw up a strategy, that we have to find a way to, we know that the markets are volatile. This is going back to the volatility versus risk category.
Yeah.
We know that the markets are volatile. We know that on any given day, any given week, month, year, it could be up substantially, down substantially. So we need to find a way to use that volatility, to protect against that negative volatility, but to use the positive volatility to our advantage. Protect against it by not being in it for the money I need to spend in the short run being multiple years. Take advantage of it by having staying power. The reason it's easy to grow wealth for that 25, 35, 45 years, they have time. They don't have to. They got 30 years, 20 years before they have to touch their 401ks, their ongoing savings. They're assuming that they're saving for retirement. They're not saving for the house next year. That's a different game. We have to identify what the goal is, to identify the time horizon, to identify the risk that we're able to take.
If you are using long-term money or assets, if you're using long-term assets to fund your short-term needs, as many people do, you got a stock portfolio and you got a bond portfolio.
Or even a balanced portfolio.
You got a 50-50, 60-40, whatever it is. And if you're doing that, Professor Plum, and you're selling stocks to fund your
what we call a systematic withdrawal system.
Right. If you're doing that, just very quickly, obviously you see problems with that.
Well, you
run
a tremendous amount of risk when you're doing a systematic distribution plan, systematic sale of a portfolio that has volatility.
Right. And
even when the stock market goes up, there are times during the year that it's down. And so in those months, you're selling more stocks than you would have otherwise. In many cases, depending upon how much it's up, you can overcome some of those downturns. But there's times where it goes down and you're selling because you cannot predict when it's going to go down and how far it's going to go down, or how long it's going to stay down, or how long it's going to take to recover. You could be selling at a negative position for quite a while. So not only are you down on your portfolio because the market's down, you're basically just adding insult to injury by selling when it's down. And once you sell those assets to spend them, they can never recover.
You lost, they're gone.
They're gone. Yeah. And then never recover. And that's one of the problems that I think people have when they look at, well, this mutual fund did 15% over the last 15 years. That should be perfect. I mean, hey, this one's done 10% over the last 10 years. I could take out 4%, the 4% rule, leave in the other 6% for inflation. I'll grow like a weed. It doesn't. Where average isn't every year.
Average is zoomed out. Average is the bar graph that slowly goes to the right over 170 years. You zoom in, there are the landmines again.
Right. There's landmines in investing. There's landmines in taxes. There's all these things that can derail your plan. They can hurt your plan. Whether the taxes derail them or just put a dent in your spending, it's a different issue. But both of these areas, taxes and or investing, can have a dramatic negative effect on your overall portfolio.
Right.
Sure, the growth could be in your favor, but that's unusual. That's not, just like you could go to Vegas and win, $100,000. It can happen.
Well,
but does it happen very often?
Well, that's why he said planning is important, but the most important part of every plan is to plan in the plan not going according to plan.
Right. And
it has to survive reality. And that's all right. So
and reality is volatility is here to stay. Emotional knee-jerk reactions to things are here to stay.
Landmines will be here tomorrow, next week. You can count on it. I just don't know what they'll be.
Taxes will be here tomorrow. I doubt they're going down.
I don't think so. I don't know. Listen, we talked buckets here, and I just want to remind you again that if you want to know more about how buckets works, if you want the short version, you can read just the first couple pages of this guide that we have. It's a bucket strategy guide. You can go to luciacap.com, LUCIACAP.com. There's a search bar up top. You can type in bucket strategy. If you haven't done so, we got a lot of downloads, but if you haven't done so, do so. Type it in. You'll find the bucket strategy guide right there. Download it. It's free. You can read the first few pages and get the gist of it like we just told you, or you can read the entire thing. I would suggest you do that and get all the nuances of this particular strategy. Everybody's strategy is different, but it's helpful if you understand how it works and some details of it. LuciaCap.com. There's a bucket strategy guide right there. You helped write that, Professor Plum. I
didn't actually do any of the writing. I just kibitzed on.
Well, you had input. I'm not saying you actually wrote it. You didn't type the words, but you had input on that, as did many of the other advisors at Lucia Capital Group. You want to listen more? Oh, you got to listen to this podcast. This episode was just bonkers.
It was a great article.
It was a great article. I said
good.
You saw how excited I was.
Yeah.
I said, no, Rick, you're going to want to talk about this. Let me throw this at you here. Go to Apple Podcasts or Spotify and subscribe to this podcast. You're going to get gems. These we've been. Did I say this before?
I don't know.
We've been really good for the last 8 or 9 months.
Does that mean we stunk before that? No.
I don't know. Maybe I don't remember, but I'm just thinking, wow, these have been really good. Don't miss a single episode. Subscribe to this podcast. And what else? I said bucket strategy, luciacap.com. Professor Plum, thank you. I knew you'd enjoy this because you've got the perspective on this. You've seen how this works over the years. You've seen it in person.
I've been living it.
Exactly.
For 30 plus years.
It's not some esoteric, ethereal, whatever thing.
This has practical application.
It really does. And hey, you know what? Bottom line, get yourself bucketized with the bucket strategy. All right. My thanks to Professor Rick Plum, Certified Financial Planner Professional, CFP Professional. We're going to catch you again for him and for the rest of the folks at Lucia Capital Group. I'm your podcast host, Johnny Dean. Thanks so much for listening. Managing your financial future. We'll talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made as to its accuracy and completeness. Benefits may be subject to change at your employer's, the governing pensions, or benefit organization's discretion. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial. Morgan Housel and any other individual or company mentioned in this podcast are not affiliated with Lucia Capital Group or LPL Financial.